What the next crisis would look like, I could probably might be a little bit helpful in stopping it. But there will be other crises. There's no way of knowing when you're in a situation like we were in the fall of 2008 or 9, when or precisely how it will end. You know the United States will come back. The factories don't disappear, the farmland doesn't disappear, the skills of the people don't disappear. But you had a system which was going to put them all in an idle position, or could do it, and there's no way of knowing how far it was going to go. What's left from the crisis is pretty much our memories. I mean, the tracks are still there, the train's still there, but we had a big interruption in 2008 and 9.
Navigating market crashes, lessons from Warren Buffett. The year is 2025, and let's face it, the economic horizon looks stormy. Markets are soaring, valuations are sky high, and everyone seems confident, too confident. But as Warren Buffett once warned, be fearful when others are greedy, when others are fearful. That's not just a quote, it's a warning. So is a market crash inevitable? And if it is, how can you protect yourself? In this video, we'll uncover the key indicators that often appear before a crash, explore Buffett's unique approach to market downturns, and show you how to position yourself for success when others are panicking. History doesn't repeat itself, but it sure does rhyme. From the Great Depression to the dot-com bubble to the financial crisis of 2008, market crashes have wiped out trillions of dollars. Yet, they follow a predictable cycle: excitement, overconfidence, a sharp rise, and then reality hits. Take the dot-com bubble in 2000. Companies with no profits and sometimes no products were valued in billions. The Nasdaq fell 83% after its peak, wiping out fortunes. Or 2008, where subprime mortgages and excessive debt brought the financial system to its knees. But while others panicked, Buffett saw opportunity. He invested in companies like Goldman Sachs and profited massively during the recovery. What's his secret? Preparation, not prediction. Buffett's strategy isn't about timing the market, it's about being ready. One of his key tools? Cash reserves. Today, Berkshire Hathaway is sitting on over $300 billion in cash. Why? Buffett calls it a hedge against stupidity. When markets crash, Buffett deploys cash into undervalued opportunities. During the 2008 crisis, while others were selling in panic, he invested, turning the downturn into a massive win. Market cycles are driven by human emotions, fear, and greed. And while most investors react emotionally, Buffett stays logical. He reminds us, you want to be greedy when others are fearful, and fearful when others are greedy. So what warning signs does Buffett watch for? There are 3 major red flags. When prices climb far beyond their intrinsic value, the risks multiply. Think of the dot-com era or today's hype around AI and meme stocks. Valuation metrics like price-to-earnings ratios hitting record highs are a red flag. High debt levels and rising inflation make the economy fragile. In 2008, subprime mortgages caused chaos. Today, rising interest rates and inflation are squeezing both businesses and consumers. When the crowd chases speculative trends like GameStop or cryptocurrencies, it's a sign greed is taking over. History shows these bubbles always burst. Buffett's advice? Don't get swept up in the crowd. When optimism or fear reaches extremes, it's time to step back and evaluate. Preparation is key. Buffett doesn't believe in predicting crashes, but in being ready. Here's how you can follow his playbook. Build cash reserves for opportunities. Diversify your portfolio with stable, dividend-paying stocks. Avoid speculative sectors and stick to strong fundamentals. Focus on companies with solid earnings, low debt, and clear competitive advantages. Buffett's rule is simple. If you can't explain how an asset generates cash, it's not an investment, it's a gamble. Inflation remains high, and rising interest rates are squeezing businesses and consumers. For disciplined investors, it's an opportunity. Buffett's approach reminds us to stay calm, focus on fundamentals, and avoid emotional decisions. So don't waste energy predicting the next crash. Focus on preparation, not panic.